Welcome back, everybody, to the Farms in BC podcast. I'm your host, Nav Seacon, and today we have two special guests, Gill and Stuart Person from MNP Accounting. And today we're going to be discussing everything related to agricultural tax. Welcome, guys.
Thank you.
Thank you.
So, Stuart, if you guys can tell us a little bit about yourselves and your background in agriculture.
Sure. So my name is Stuart Person. I'm the Senior Vice President of Agriculture for MNP. I grew up on a grains and oilseeds farm in Saskatchewan. Still actively co-own and operate that farm. We plant about 7,400 acres. I've been with MNP for about 16 years now, and been in the senior vice president role and going in my fifth year now. So my role with MNP is I head up all areas of agriculture coast to coast in Canada. And I'm also the national leader of crops, which is my specialty given that I have a grains and oilseeds background. So, yeah.
Thank you for having us. My name is AJ Gill. My background, I am born and raised in India. I moved to Canada when I was 15. Like a lot of us, we have farming in our blood. I grew up on a farm in India, but moved to Winnipeg. Farming was a lot different in Winnipeg than what I was used to. Once I finished my schooling and all that, I found my way into farming and started working with Ministry of Agriculture in Winnipeg. So when I was working with Farming and Program Department, towards the end of my era with the federal government, I was managing a team of specialists that looked after complex operations all across the country. That brought me to BC, and there was an opportunity to start the AgriStability Administration out of Kelowna, BC, and I was asked to come and join the Ministry of Agriculture. And in 2008, I made my move to BC and worked with them for 13 years. For the last 5 years, I was a department head for the risk management programs like AgriStability and Agri-Invest out of BC, and sat on some national tables where we decided what the policy would look like, and working with administrative working groups. My paths crossed with MNP, and I met Stuart Person, and I was asked to switch tables, come over to MNP, and about 3.5 years ago, I joined MNP, and now I lead our service line that looks after risk programs for all our farmers. So we have a specialty service line called Ag Risk Management Resources that helps farmers plan for risk management strategies using insurance programs like private insurance programs and the government programs, and that's the service line I lead nationally.
Nice. It's a big resume. MNP. So MNP is national. A lot of the larger farmers know who MNP is. To some of our viewers, could you explain, BC, how many offices you guys have, and how far national are you?
So I'll start with the national, and then we'll let AJ tell you a bit more about BC since he's our provincial leader as well. So nationally, we'd be just over 125 offices coast to coast. And the neat thing about that fact is Canada is not a place with 125 large cities, right? So if you're going to have that many offices, you're going to be in some smaller centers, and that's where agriculture happens. And so it's because of our presence, in towns like, Williams Lake, BC, we have an office there. We have an office in Rimbey, Alberta. We have an office in Strathroy, Ontario. These are all small farming communities, right? It's because of our presence in that 125 plus offices that we have such a strong presence in agriculture. Mm-hmm. Coast to coast in Canada, we would, we've got it broken down. We focus on crops in the areas where the crops are stronger. We focus on livestock. We have a food and beverage practice. In the prairies, we have a hutter rate practice that we have a group that focuses dealing with that cultural niche. Yeah. So we've got it, I guess I would say, covered in that regard. And then nationally, we would have a very strong food and beverage practice based out of Toronto, but with a very strong team here as well in the Vancouver region. So I'll let AJ tell you a little bit more about British Columbia specifically.
Yeah, and from our province's point of view, we have 23 offices all across the province. We have 7 offices that focus on primary ag, and then we have, I think, about 9 offices that also do value add, food and bev, and on top of primary ag.
Yeah.
So like Stuart would have said, we're very niche orientated. So our ag GPs, 50+% of their practice is agriculture. So they just work. So they understand agriculture.
Do you guys have an office on the island?
Yes,
You do,
multiple offices on there.
Oh, really?
Yeah.
Okay.
Yeah, we've got, so we would have Chilliwack, Abbotsford, Langley, Island,
Surrey.
Williams Lake, Kamloops, and Kelowna.
Nice.
And on the island, we have Victoria, Duncan, Nanaimo, Courtenay Comox, and Camel River.
So what I want to dive into is just pretty much, I want to talk about the different type of programs there are and talk about some farm tax strategies. One thing that I do get questioned a lot is for grants. So when somebody is buying a farm, they're saying, hey, is there any grants available, or any sellers that are looking to expand or looking to do any R&D? Is there any grants that you guys are familiar with?
Well, there's a large number of grants that are out there. So like I was saying, as part of my introduction, we have a service line that focuses on risk management strategies. So the government puts about $3.5 billion. This is a 5-year agreement. They put $3.5 billion. Out of that, $2.5 billion is federal provincial shared, with 60% of the money coming from the federal government, 40% coming from the province. Then they have $1 billion that are 100% funded by the federal government. Then it breaks down further. Then we call risk management programs, a bunch of money, about $1 billion that goes into risk management programs. And then there's non-BRM, we call them non-business risk management programs. So risk management programs would be like AgriStability, crop insurance,
Sure.
agri
So that's all
recovery,
covered with the
agri-invest.
grants.
That's covered within that.
Yeah.
And then there's a bunch of different grants that are like by BC.
Yeah.
You got export, if you're trying to develop your market, so there's grants for that. And then there's a bunch of other grants, including the last one that we've had a lot of success with is called CDAP. It's a Canadian Digital Adaptation Program. That grant basically focuses on you coming up with a plan, what your issues are on the farm, what you're trying to solve. We work with a consultant. Government provides $15,000 for you to get a report. And then there's a bunch of money that you can access through interest-free loans to come up with the solutions for that. And then there's also wage subsidies that come out of that grant that you can use for if you're a project that you're working on, and you can use that funding to pay for youth workers on your farm. And then there's lots of other initiatives like SFU has an initiative where you can double up on some of these grants, where they have an incubator for ag technology, and they'll provide some funding towards there. So we have our consulting group works with a lot of these grants. Some of them we can't work directly; that the producers have to apply for them, but we can guide. We can guide him and let him know what it's all about, and then there's others that we can get involved and help them apply for.
And I think that's the disconnect. A lot of the farmers are not even familiar with a lot of the grants. I know there's is it Ag BC on their website? I think they issue a lot of the yearly grants for specific different categories. Either it's dairy, poultry, berries, vegetables. I think they need to get the message out there of this availability of funds. Because from my knowledge, if they don't allocate those funds to the farmers, then those funds then get allocated in different other sectors, right? So it's very important for people to take advantage of some of these grants. When it comes to the baby boomers, and a lot of them are starting to retire, and you're seeing a lot of them wanting to either sell their assets, or they're looking to roll over the assets or the farms to the next generation that's farming. So what type of tax implications are in play there when the father is looking to transfer a lot of the operating farm assets to the next generation?
Right. So a couple of critical points here. The first one is you want to make sure that your farm assets are qualified farm property. And that's something that gets overlooked by a lot of producers and sometimes even by their advisors if they don't understand how the definitions work. So I won't get into the definitions here, but understanding that your farm assets are qualified farm property is critical for a couple of reasons. First of all, you need to make sure that that's in place so you can roll those assets to a child. Mm-hmm. If you want to gift it, or if you happen to suddenly pass away, you want to make sure those assets qualify for the family farm rollover. If they do qualify, those assets go tax-free.
So that's
huge.
Yeah. So that's the capital gains.
It's different than the capital gains deduction. Okay. This is the family farm rollover. Yeah. And that's a massive benefit because you could, especially here, right? Because you could have land that's worth several millions of dollars, right? That you may have only paid a few $1,000s for, right? So you want to make sure that you've got your affairs in order and structured properly there. And it's tricky. It's not simple always. So plan carefully, I would say.
Yeah. So how far in advance would you have a family come in before they start executing a lot of this stuff, like for planning?
From a tax perspective, the more years you can give your tax advisor, the better they will do for you. So if you show up 10 minutes before you want to do it, you're going to probably pay some tax. If you give them 5 years, you're going to have a great plan. And if you give them 10, it'll be even better.
Okay.
So time is your friend when you're tax planning. And so you want to start early. The second thing that's really important with that qualified farm property definition is the capital gains deduction. So again, you need to meet certain tests to make sure that the asset that you're dealing with meets the definition such that you can access the lifetime capital gains deduction. And every Canadian individually has $1 million lifetime capital gains exemption, which means you can trigger $1 million gain and not pay any income tax on that $1 million. So again, planning ahead to make sure you've got things structured and in certain people's names. The more people that are on the ownership title, the more exemptions you can have access to, right? And you also want to be cognizant of the fact that if you have property in only one name, let's say right now, well, if you plan it such that you're moving that property to your children or your grandchildren or great-grandchildren, depending on how many generations are alive, you can, plan it out such that you claim a portion of the gain, say 1 million, and then your children start claiming a portion of that gain, and then their children claim it as that works through the family, right? So you want to make sure you always use that capital gain exemption. One mistake we see so often is that people will use the family farm rollover rule to roll everything tax-free, but they didn't take advantage of their exemption on the way out, so they didn't claim their $1 million. And we see that happen all the time, and we go, "Oh, what a missed opportunity!"
Yeah,
right. So, but 1 million is a great amount of money. Maybe not so great if you own a number of acres in this region, but it's still helpful, right? Because you're talking about almost $270,000 in tax savings here in British Columbia.
That's right. What about transfer tax? Is that applicable?
Yes, transfer tax is an issue. I'm not going to get into the details of how exactly it's calculated, but given the value of properties in British Columbia, it can be a very significant number.
I think we pay the most highest property transfer tax.
Yes. So planning around that is also critical. And there are exemptions in place for farmers to be able to move it to family members or, even moving it within companies. There are ways to work through and not have to pay that transfer tax if it's properly structured. So again, you want to make sure you've done your planning such that you're not falling into that trap and going, oh, whoops. And the whoops could be hundreds of thousands of dollars.
So within that plan, you may also want to put out all the assets even in a trust or however that works for the family situation. What if someone made a plan 10 years ago? How does that work if they want to amend that plan over time?
Yeah, I mean, tax planning, anything you do in tax planning is always, you can change it, right? It may not, the way you set it up originally may not be as appropriate because tax rules change or because your family circumstances change. So any plan that's put in place is changeable. It might cost you a few dollars to do that, and it might cost you a little bit of tax sometimes to do that as well. But I mean, the ultimate goal with our tax planning people at MNP is to just find a way for you to pay, the least amount of tax possible, or as much tax at the lowest rate possible would be the goal, right? So, yeah.
We've also seen it where there's something called a rollover exemption, where say if some of the farmers want to sell some of their assets and they either want to move their assets over to either a different province or expand on their operation, maybe sell one of their smaller titles, buy some bigger titles, sell their operation here in BC or move it out of province. I know there's, you want to talk a little bit about the details of the rollover exemption, how that really works.
Yeah. So what we're really talking about here is the replacement property rules.
That's right. Replacement property.
And so, yeah, the replacement property rules are in the Income Tax Act. Again, something you need to really look at on a case-by-case basis. Yeah. It's a little tricky when you're moving out of British Columbia, especially in a high land value area, and into a lower land value area, say like Saskatchewan or Manitoba. So if you're doing that, you do need to do some analysis. The rules, in theory, would say you're replacing your property with the same or similar property. So if it's farmland you're selling here and it's farmland you're acquiring out there, well, it's similar property. Is it exactly the same? Well, if you're selling 100 acres here and you're buying 10,000 acres there,
because that's what the difference
it might get a little trickier. And so you might want to do some analysis and make sure that you dot your I's and cross your T's on that, and make sure that that you qualify. But yeah, that is the essence of that rule, is such that you can. I was farming here. I no longer want to farm here. I want to go farm over here. Why should I have to pay tax on my money that I have invested? I'm going to take a tax deferral and go over here and continue farming, and I'll pay tax someday down the road if I eventually sell.
What about if it was just here local, but someone is farming here and just wants to buy an operating farm here? Does the farming have to be related? Like, let's use blueberries as an example. I sell a blueberry farm. Does it have to be a blueberry farm, or could it be a different type of different?
Could be a different type of farm. Yeah.
Okay. It just has to be an operating.
Yeah, it's got to be a business for sure. And, again, I would say hard to answer that question in general terms. So you definitely want to do the analysis and kind of, put some paperwork behind that. But yeah, I mean, all of those types of things are things that we would look at. And in many cases, I would say, you could utilize those rules.
When someone is going through that situation, can they get a preliminary decision, say, and how long would that typically take?
You can request a judgment from Canada Revenue Agency ahead of time if you're not certain. And I think from our perspective, we might do that if we weren't certain.
Yeah.
But you got to be careful. Those are dangerous as well, because if you request it and they say no, well, then for sure it's a no. And you also might set some precedent that you didn't want to set for other people.
Okay. Well, still get the advice.
Yes.
And kind of know your options.
If it's a big number and you're very uncertain, it's probably safer.
Yeah.
But I mean, in the world of tax planning, I wouldn't say that, I would say there's black, there's white, and there's gray.
Yeah.
And, sometimes, the tax planning happens and you get in, the professionals are going to make a judgment call on how they interpret the act. And if our interpretation of the act is that it's good, then we would feel confident in having to defend that if it was challenged by the CRA.
I want to talk about AgriStability and crop insurance. Mm-hmm. So a lot of the farmers have heard of AgriStability. A lot of farmers that are buying farms that get into farming have no clue what it is. So there are some massive benefits like you touched earlier. So what is AgriStability and how does that work?
So AgriStability it's a margin-based program the government provides to keep agriculture sustainable. Whenever you have any bumps in the road, any kind of natural disaster or anything that goes sideways on your farm that you have to protect the viability of your farm, government provides this program. It's very cheap insurance, I guess you can say, on AgriStability. You can protect your balance sheet up to $3 million under the program. It's a margin-based program. What I mean by that is like you have whatever your sales are going to be in that farm, and any of the expenses, and there's allowable expenses that go into anything that like your labor, your fertilizer, your seeds, anything that goes into to grow those sales.
Yeah.
So you take your allowable sales minus those expenses, that kind of becomes your margin. and that margin is protected. They take your last 5-year average, Olympic average, drop the high and low, and that comes your that's what becomes your reference margin, and that's what you're trying to protect. A lot of times when you have newer farmers getting into farming, there's a misunderstanding. They say, I have to wait 5 years before I can participate in this program. They don't have to. You start participating in the program the year that you bought the new farm. They'll take an area average. So based on if you have a 10 acre of blueberries, they'll look at on your area average what your benchmarking is. If you're a mature farm, you can probably get an $80,000 worth of reference margin coverage, and that becomes your protection level. That becomes your reference margin.
So is that a percentage based on that number, or how do you determine that number?
How do you determine if you're a new farmer?
Yeah.
So the government, what they do is they call something called BPUs, benchmarking per unit.
Okay.
So they know for 1 acre of mature blueberries, what is your projected benchmark
Average
for that?
yield,
What's your average yield for that? Yeah. And they'll give you based on your productive capacity. They'll figure out a reference margin for you. Okay. So the program is very simple. You have the year that you're purchasing. You have till April 30th to participate in the program. You let the AgriStability Administration know that you purchase this farm, or you have a farm you want to participate in. They'll send you something called an enrollment notice, which will have a fee. It's a very cheap insurance, $385 per $100,000 worth of coverage. Nice. You pay your fee within 30 days or by April 30th when they issue your enrollment notice, and then you are protected for if your margin drops below whatever your reference margin is going to be for that year. They don't pay you for the first 30%. Now that's another myth that a lot of people misunderstand, that I have to have a 30% drop in my income or my revenue. It's a 30% drop in your margin, which can be very small. Like depending on what kind of farm you're running. If you have a blueberry farm, which you use a lot of labor for, like if you're not mechanical harvesting and you have high labor and your margins are small, you might only need like 6 or 8% drop in your revenue before you'll start triggering payments from this program.
Nice. What about crop insurance? So crop insurance is a different program.
Yes. Which
covers crop based on certain percentage of coverage. Mm-hmm. So I believe, like my family, we do it. And I guess there's always an option of getting 25% coverage, 50% coverage, or 75% coverage, right?
So yes, crop insurance is very much different. It's based on where AgriStability is based on your whole farm. Yeah. And crop insurance is based on each commodity that you purchase the insurance for.
The production of
that. Where crop insurance would cover you certain perils and your production, the quality and quantity on your fields. AgriStability will go one step further. It covers your on-farm losses and also your off-farm losses. So, for example, you have blueberries, you get flooded, you lose your production, or you had a hail or whatnot kind of thing. Crop insurance will come and pay you whatever your individual valuation they have for your farm. Now, if you've already harvested and something goes sideways, or the price drops, or you have or it's a peril that's not covered by the crop insurance, AgriStability will step in and still cover you for that. So we've had issues in the Okanagan where last year there was some issues with packing cherries.
Yes,
so people
I'd heard about that.
Their cherries, they gone in and they weren't able to get packed in a timely way, delivered because of the quality was so poor, they weren't able to get any prices. AgriStability would cover you where crop insurance wouldn't have covered you for that loss. And same thing happens, a lot of people are shipping overseas. So we have a huge market for cherries that go overseas to Asia. And now we have blueberries that are starting to go overseas as well. So that receivable is also protected under the AgriStability program. If something goes sideways, or you have a chargeback because the buyer's not happy with the quality when they receive it and they refuse to pay you, that's something that you can claim against AgriStability. There's steps you got to follow, but AgriStability will cover you for those losses.
Locally, if you guys remember the Abbotsford flood that we had, there was a lot of crop damage.
Yes.
So which program would that have fallen under? Would that fall under crop insurance, or would that have fallen under AgriStability? Because a lot of production was down.
There was a lot. Yeah,
there was a lot of damage too.
So I was part of that, from MNP. I had just recently joined MNP at that time. Yeah. And so I was kind of helping on ground here what to do. And there was a number of programs that were going to, in a situation like that, because you had a huge disaster. So there's a federal program, disaster assistance program, which covered farms that were up to $2 million in revenue. And usually it's about $1 million, but I think that time the government has increased it to $2 million. And so that was your first go-to. You go to that program and they covered for some of your losses. Then you had your private insurance. If you had insurance, business interruption insurance, and your insurance on your equipment, then you go to for that. And then you had crop insurance, and then AgriStability, and then agri-recovery. So agri-recovery in itself is not a program, it's a framework for situations like this. When you have a disaster, which is going to require you extraordinary expenses, which normally are not part of your business, the government has this program. There's no limit on this fund, but it has to be triggered. The province and the federal government has to agree to it. They do a report and say, yes, there's some extraordinary costs that are here, which we've seen during avian influenza. They've triggered agri-recovery. During the floods, they've triggered agri-recovery. And then that would cover for any extraordinary expenses that you would normally have.
So, and during the blueberries that needed to get replaced, so that was part of the recovery program.
Yes.
Okay.
So
I think they gave a certain percentage per acre for ripping everything out, and then a percentage for replanting. Yeah.
So all three programs worked most of these programs, the government designed, they work hand in hand. Yeah. So agri-recovery, crop insurance, and AgriStability. All three of them work towards the replacement of those trees and all the production losses. So all the extraordinary cleaning costs and ripping and all that kind of stuff was paid through agri-recovery. Yeah. Replanting of your trees was paid through crop insurance. They pay up to a certain amount per whatever the valuation. I think it was. I can't remember the exact amount per vine. And then you had any of your loss of your business or loss of your profitability for a number of years was covered through the AgriStability. Now, if you didn't participate in any one of those three programs, you lost the portion that was going to come from that program.
And there are some people that didn't apply, but I think the BC government also stepped up and you were additionally allowed to apply for additional funding. From my understanding, I don't know if that was part of those programs or was that just completely separate?
So the province of BC was actually a leader in this. What they've done was they increased the coverage, the payment rate for AgriStability program from 70 to 80%.
Okay.
So they bumped it up. That was all 100% funded by the province of BC.
Increase.
Since then, we've had now federal, provincial governments have agreed. Now all the provinces have increased starting this year in 2023. Now all the payment rate has increased to 80%.
And they kept it there.
They've kept it there now.
Yeah. I just got to say one thing on that. When the floods happened in the Sumas, AJ was our provincial leader at the time, and AJ, along with our teams in Chilliwack, Abbotsford, and Langley, got together, and I sat in on a number of the calls as well to see what I could do to help. And we had other national resources, and it was a big team effort. Yeah. But AJ and the team just did spectacular in terms of figuring out what we could get for our clients. Our clients were busy trying to save livestock and figure out what to do with the water and get it out of there. These guys were in the background figuring out where are we going to get the money for these clients of ours, and they did a spectacular job when we got the information out. And I hope the clients feel the same way, but I just thought they did a spectacular job for that.
No, you did, because we're also with my family. We do our accounting with MNP as well. Those floods did not just affect Abbotsford. Mm-hmm. All the diking systems, all the ditches, everything was backed up from there all the way to Delta. Yeah. A lot of crops were damaged. Yeah. So it wasn't like we hear just Abbotsford, Sumas, but it affected everybody in the valley, in the lowlands, right?
We were very proud of their work on that. But, that goes back to the whole purpose of MNP having this
division,
Ag-Risk Management Resources service line that AJ is the head of. That's what it's there for. When those types of crises come up, we had the ability to mobilize those resources and get on it.
That's right.
And be there for our clients.
Yeah, that's awesome. I want to get into a little bit about so what we do is we sell agricultural land, and we help a lot of our clients buy agricultural land. When we meet a lot of our clients, we give them advice. And the first thing we always ask them before they're thinking about selling is, have you gotten advice from your accountant, and what is your tax implications? So a lot of them, I would say majority of them never do. They just say, hey, we want to sell, let's go sell. Yeah. So I always advise them, talk to their accountant, figure out which exemptions that are available to them. One of them you've already mentioned is the capital gains exemptions. If they qualify for up to $1 million, then we've also spoken about the rollover exemption or the replacement, if that applies. There's also a principal residence exemption. Now, for farmland, you cannot exempt the whole acreage. No, right? So can you speak on that, and what does apply? How much land and how they value that?
Yeah. So if you're the owner of the farm and you have your personal dwelling on the farm, you would look at it as there's a defined acreage. I think it's 1.2 or 1.4 acres, that you would carve out and say, okay, this is my home. This is where I live. No different than if you lived in the city. And that is what you would classify as your principal residence, assuming that you meet a few tests. Mm-hmm. So if you've got a property that you live on the farm, but you also have a property in Whistler, and you might have a property, over on Vancouver Island, you can't claim that exemption on more than one property at a specific time. Yeah. So you have to declare which years you were principally living on that house that's on the farm. And if you meet that test and you can say, yeah, that was my principal residence, then yes, you can claim the principal residence exemption, which means it's a tax-free disposition on that house.
Now, that's if they were farming.
If they were farming, and again, you got to remember that's if the house is in their name personally.
Personally, not a corporation.
It can't be a corporate house.
Okay.
Yeah.
I've got a follow-up question. What if they weren't farming, and it was a 5 acre, 10, 20, or even 100, and it was all a hobby farm, and it was strictly for their personal enjoyment?
Yes.
Can they classify the entire thing, or would that still?
You would have to take a look at every situation separately. Yeah. But yeah, I mean, if you could make the argument that the property that you're living on was all necessary for your personal enjoyment, or let's say your house is on 10 acres. Of which 1 acre is where the house and the yard is, and the other 9 acres is the backside of a mountain. You can't farm. Well, you can't do anything with necessarily. Then maybe you would have an argument that the whole thing is it goes together. You would never subdivide and sell off the other piece necessarily, right? So you would have to look at the fact by fact pattern and then document that. And again, highly recommend you get a very good tax accountant to dot your I's and cross your T's on that one. But yeah, there could be that argument there.
And that's why we always say have these discussions with your accountant, know what your payable is before you sell, so you know what you're left with.
Right.
We also have situations where there's a share purchase where they have to sell the corporation. But then some of them still have the option to do an asset sale out of the corporation. Yeah. Could you guys speak on that a little bit?
Yeah, for sure. So a couple things on that. First of all, on a share sale, again, if you make sure that your farming corporation is a qualified farming corporation, so there's some tests that need to be met there that, the bulk or the majority of the assets are farming assets. You don't want to have a bunch of non-farming assets in the company. So as long as most of the assets are farming assets, then that's the shares of that farm are qualified farm property. And those shares can be sold and you can claim your capital gains exemption on those shares, right? Okay. So that's a really big benefit, right? Especially if you happen to have multiple shareholders, everybody gets a $1 million exemption, right? So the other option that you have with selling shares is you end up getting taxed at capital gains rates. And that's an advantage over what we would say dividend or regular income rates. So in British Columbia, you're just shy of 27% on capital gains. So if you sold the shares of your farm and you didn't have enough capital gains exemption, or you'd used it up previously for some reason, you know, all the gain on that farm when you're selling the shares of the company would be taxed at 27% or just shy of 27%, versus if you sell the assets outside of the farm and then you end up with a bunch of cash and then you try to take that cash out, you're going to fall into a much higher tax regime, probably, you know, in the neighborhood of 40 to 50%.
Oh, wow.
BC, right? So there's a spread there that's significant, so that you would want to try to sell shares versus selling assets.
It would also be a good idea to talk to somebody about the risk management plan on that, how it's going to benefit you. Because if you do a share sale, you have an option to bring the margins over, like we were talking earlier, that if you are be a new farmer, you're given something called a beginning farmer margin, which is based on the area average. But if you're doing a share sale, and then you have an option to bring those margins over, especially if you're buying a good managed farm that has very healthy, strong margins, and you might want to do a consideration which one's going to help you better to protect your risk moving forward. And that could be a decision point as well for you.
Okay. No, that's some good advice. Now, when buying a farm, I get this question a lot too, is do we buy it under our personal name or do we buy it under a corporation?
Yeah, I mean,
and what's the difference? And I've gotten this question from different accountants, right? But what's your take on that?
It's just given the values of farmland, especially in British Columbia, it's extremely hard to buy a farm or anything farm related in your personal name. And the biggest reason is in order to pay for it, you need after-tax money to make the payments on the principal portion of a loan or to pay for the land. So if you had a whole bunch of money personally that was tax paid, then we would definitely take a look at you buying personally. But most people aren't in that situation. And so if you're needing to go finance the purchase, then you want to be looking at a corporation. And the main reason for that is corporations are taxed at a lower rate on the business income. So if you're personally owning the land and you're earning income off of that land, you're going to be taxed at a rate somewhere between, call it 25 and 50%, depending on what tax bracket you're in. Whereas a corporation, if it's a small business corporation, you can get down into some really low rates and, you know, into the 11-12% range, or you can, if you're a large corporation, you'd be call it 27% range, somewhere in there. So you would really want to know, again, it depends on the facts. You'd want to look at those facts. But what we're seeing today is most young people, especially that want to get into agriculture, we're using corporate structures because the after-tax money that they have left to pay the principal payments on their debt is significantly higher in a corporate structure.
Yeah. What about if it's just they're buying it just for a hobby? Like they're buying acreage for a hobby and they're going to have their principal residence there, and it's more for enjoyment than it is for business.
Yeah. In that case, you got to be really careful, because anything that, as soon as you use the word hobby or personal enjoyment, it's not a business asset anymore.
That's right.
And so if you try to put that in a corporation, you're going to run into issues where the CRA is going to look at that and say, well, you're getting a taxable benefit by having a corporate asset for your personal use. Yeah. And so you probably fall into the trap there of triggering more tax than you'd like in that situation. So generally we would say, hey, if it's for personal use, you need to own it in your personal name.
Okay.
Yeah.
When buying a farm, being farmed or not being farmed, the biggest question we get is GST applicable? So, and who's responsible to pay GST? And till this day, I have asked many, many accountants, and I still don't have a direct answer.
So I'll give you the same answer they did. It depends.
Yeah.
But I would say in general, if it's a farm and a commercial asset being an active farm or farmland, typically what we would have in that situation is the buyer is usually registered for GST, and usually the seller is as well, because they've been running a business. So if both parties are registered for GST, then it's a very simple transaction. The purchaser generally reports the GST for both sides. and it becomes a wash on their return. And so there's no money that needs to change hands. If one of the parties is not registered, and I would say most times it's the seller that's not registered for some reason, yes, then you can run into a few different problems where GST may or may not need to be charged. And again, you need to work with your tax advisor to analyze those situations. So, again, I highly recommend you seek advice on the situation. But generally speaking, most transactions are pretty straightforward, and it's the purchaser that would report that GST.
Yes. So even, and that's where we do see it is people that bought these farms 20, 30, 40 years ago weren't advised about GST.
Yeah.
So none of them have a GST number.
Yeah.
And come when they sell it, that's the problem.
Yeah.
Right.
And technically speaking, I mean, depending on what you've been doing with that land, if you've been farming or if you've been renting that land for cash, you probably should have had a GST number either way.
Correct.
Even if you're cash renting it, you should be charging GST on the rent.
Yes, and those are a little bit more easier to analyze. It's where it's tricky is when there is no farming, and a lot of people here locally, that's a big purchase for them. They'll buy acreage just to maybe put up a house and have that acreage lifestyle.
Right.
And so that's where it gets tricky for those people because they're always debating if GST is.
Well, if the asset is moving outside of the corporate, a commercial use, including farming, if it's moving outside of that and over to a personal use, at that point in time, the GST does need to get paid.
Okay. And
then it's done, right? It's no longer a commercial asset. So the government does want their GST once it's moving to a personal.
But nobody wants to pay it.
No, nobody wants to pay it, but they would like to have it.
Definitely. Gentlemen, thank you. Thank you for coming out. For our listeners that have any questions or they need to get a hold of you for your assistance, what's the best contact information?
Yeah, so first of all, you can check us out on our website, mnp.ca. We under clients and services, we have an agriculture page where you'll find AJ and myself. You can reach me on email at stuart.person@mnp.ca. And AJ?
Yeah, same. aj.gill@mnp.ca. Pretty simple. My name at mnp.ca.
Awesome.
Yeah, and we have a great team here in all over British Columbia, actually. So no matter where you are in British Columbia, we will have an office close to you. And so if you want to check out who those people are on the website as well, you can find them there, or AJ and I will connect.
Help you direct. Awesome.
Yeah.
Thanks, guys.
Yeah.